On the morning of January 7th, 2009, Ramalinga Raju sat down and wrote a letter. It was addressed to the board of Satyam Computer Services, one of India's largest and most celebrated technology companies, a company with 53,000 employees, a company that had won awards, attracted global clients, and been held up as a symbol of India's rise as a technology superpower. The letter was a confession. Raju had been falsifying the accounts for years. The cash on the books, $1.5 billion, didn't exist. It had been invented. The profits had been inflated. The entire financial picture that investors, auditors, and regulators had been looking at was a fiction. He sent the letter. Then he waited for the police. This is the story of Satyam Computer Services. And it begins not with greed in the conventional sense, but with a lie that was told to buy time and then could never be stopped. Satyam was founded in Hyderabad in 1987 by Ramalinga Raju and his brother. The name means truth in Sanskrit. By the late 1990s, it had grown into one of India's premier IT outsourcing companies, providing software services to hundreds of global corporations listed on both the Bombay Stock Exchange and the New York Stock Exchange. Raju was celebrated. He won the Ernst & Young Entrepreneur of the Year award in 2007. He sat on the boards of prestigious institutions. He was the face of a new India, tech-savvy, globally connected, entrepreneurially bold. But underneath the reputation, the numbers had never been quite what they appeared. The inflation of profits had started small, rounding up margins here, smoothing earnings there. The kind of adjustments that felt temporary, that felt manageable, that felt like something that could be unwound once the real performance caught up. It never caught up. And the gap between reality and fiction grew wider every quarter. Here's what makes the Satyam fraud different from almost every other case. The mechanism was almost embarrassingly simple. Raju and a small circle of insiders inflated the cash balances on Satyam's books by creating fictitious bank statements. They would take real bank documents, alter the numbers, and present them to auditors as genuine. No complex derivatives, no offshore shell companies, no sophisticated financial engineering, just altered documents, repeated quarter after quarter for years. By 2008, the fake cash balance had grown to $1.5 billion. Fictitious interest income was being reported on money that didn't exist, and the gap between the real company and the stated company had become so large that Raju could see no way out that didn't involve complete destruction. And then, he made it worse. In December 2008, Raju attempted to use Satyam's inflated stock price to make an acquisition, buying two companies owned by his family for $1.6 billion. The deal would have transferred real assets into Satyam, partially plugging the gap between the real books and the stated ones. The market reaction was immediate and savage. Institutional investors saw the deal as a blatant related party transaction designed to benefit the Raju family at shareholders' expense. The stock fell 55% in a single day. The deal was abandoned within hours. But the attempted acquisition had done something Raju hadn't anticipated. It had drawn intense scrutiny to Satyam's finances. Analysts started asking harder questions. Institutional investors started demanding answers. The window that had stayed open for years was closing fast. Raju spent the next few weeks trying to find a way out. He approached potential acquirers. He looked for investors who might inject real capital. He searched for any mechanism that could bridge the gap before anyone looked too closely. Nothing worked, and on January 7th, 2009, he wrote the letter. The confession was extraordinary in its specificity and its candor. Raju disclosed the inflated cash balances, $1.5 billion, that didn't exist. He disclosed the fictitious interest income. He disclosed that the gap had been growing for years, and he described the experience of maintaining the fraud in terms that have since become one of the most quoted passages in the history of corporate crime. He said it was like riding a tiger, not knowing how to get off without being eaten. The board received the letter. The stock was suspended. Within hours, Indian authorities had launched an investigation. Within days, Raju had been arrested. The company that had 53,000 employees the day before the confession was now in free fall. What happened to those employees is the part of the story that gets lost in the focus on the fraud mechanics. 53,000 people had built their careers at Satyam. Many had stock options they had been planning to exercise. Many had mortgages, car loans, and family obligations tied to a salary from a company that was now paralyzed. The immediate uncertainty, whether the company would survive, whether salaries would be paid, whether their roles still existed, lasted for months. The Indian government moved quickly to stabilize the situation, appointing a new board, launching a global search for an acquirer, and providing assurances that employee salaries would be protected. Tech Mahindra, a subsidiary of Mahindra Group, eventually acquired Satyam in April 2009, rebranding it Mahindra Satyam and later merging it into Tech Mahindra entirely. Most employees kept their jobs, but the months of uncertainty, the collapse in the stock price, the destruction of the options, those losses were real and permanent for thousands of people who had nothing to do with what Raju had built. The auditor question haunted the aftermath. PricewaterhouseCoopers had been Satyam's auditor. They had signed off on the accounts that contained $1.5 billion in fictitious cash for years. How? The investigation found that the audit partners had accepted bank confirmation documents, the altered statements that showed fake balances, without independently verifying them directly with the banks. The most basic verification step in auditing cash balances, calling the bank directly, had not been performed. 2 PricewaterhouseCoopers partners were arrested and charged in India. The firm was subsequently banned from auditing listed companies in India for 2 years, a sanction without precedent for a Big Four firm. The case prompted a global conversation about audit quality, the independence of auditors from their clients, and whether the profession's fundamental procedures were adequate for detecting fraud. Ramalinga Raju was convicted in 2015, more than 6 years after his confession. He received a 7-year prison sentence, along with several co-conspirators, including his brother. He had already served significant time in custody during the lengthy legal process. The conviction came with fines and disgorgement orders. But for many of the investors who had lost money and the employees who had lost years of stock appreciation, the outcome felt more like accounting than justice. There is one dimension of the Satyam story that doesn't fit neatly into the standard fraud narrative. Raju confessed voluntarily. He wasn't caught by a whistleblower. He wasn't exposed by a short seller. He wasn't unmasked by a regulator. He sat down, wrote the letter, and turned himself in. Whether that reflects genuine remorse, the calculated judgment that exposure was inevitable, or something more complex, nobody fully knows. But it makes Satyam different from almost every other case in this space. The man who built the fraud is also the man who ended it. The name Satyam means truth. The company spent 2 decades building a reputation around that name in global markets, with international clients, on stock exchanges in 2 countries. And for most of that time, the name was a lie. $1.5 billion in fake cash, altered bank statements, quarterly reports that described a company that didn't exist, and 53,000 people who showed up to work every day in a building whose foundations had been hollow for years. They found out on a Wednesday morning in January 2009. Most of them found out the same way everyone else did, by reading the news. If you want the full case study breakdown with red flag checklist, everything that should have caught this fraud years earlier, it's linked in the description. And if this is the kind of story you want more of, subscribe. New corporate collapse every week.